Okay, in the interest of time, we're going to get started. And welcome, everybody. This is an exciting seminar because many of you are just getting out there, looking for your first home, getting ready to save for it, learning all about the fun things about buying your first home. So lots of new things, and we actually have updated the presentation to really reflect some of the current market conditions. So we do have some new things that we've added in. So a couple of things for the people who are on the Zoom web conference, just to let you know, if you do have any questions, at the very bottom of your screen, there should be a Q&A button. If you hit the Q&A button, just before, at the very end of the webinar, I'll open up that section and I'll definitely answer any questions that you do have. Okay, and other than that, let's get going. So here are some of the things that we're going to cover tonight. So first thing, getting ready to buy your first home, and all the exciting things that that come around that. We're going to talk a little bit about credit scores in Canada. So that's a very critical item that you really have to know about, because before you really come into a branch, you really should have a general sense of where things are with your credit. So we're going to go through that, how it's impacted, how it goes lower, how it goes higher, etc., and how to save for a down payment, as well as how much do you actually need for your down payment. So we'll go through a bunch of different options there. Pre-approvals versus RBC firm approvals. This has taken some definite changes over the last little while. RBC's always had a firm approval process, and we're going to talk a little bit about that. But I also want to talk about what the pre-approval process is like and what that really does mean to you. And then, of course, the importance of having a team around you. So, you know, it's great you have a mortgage person, a lawyer, a realtor, but if they're not working as a team, you're really not truly getting the value that you need. So we're going to talk a little bit about that as well. Okay, so getting ready to buy your first home, there's definitely a few things that you want to consider and that you want to think about. So are you emotionally ready? Okay, so when you're renting, you know, you're obviously giving the landlord the money, and of course they're paying their mortgage, and you really don't have a whole ton of concern. Something breaks, you call somebody and they fix it for, we'll call it free. Something major happens, a flood, etc. Again, it's not your problem. It really becomes the landlord's problem. But with owning a home, you have to make sure that you're ready for all the ups and downs. It's a completely exciting time, but you have to be ready. You know, are we ready for you know, things to break or things to manage, or, you know, crazy neighbors, or all sorts of different things like that. So there is a certain degree of emotional readiness, financial readiness. So, you know, are you ready for possibly not only a bit of a higher, what we call shelter payment, but what about having to pay additional things like property tax, additional items like heat, hydro, fire insurance, all that sort of stuff. So there are definitely some different things you have to be prepared for financially. There are a couple little quizzes you can have a look at. The quizzes are great, but if you really want someone to kind of sit down, go through some numbers, make sure it all makes sense, reach out to me. We can definitely do it either in person, or we can also do it even over a bit of a web conference similar like this, and kind of draw them out and see what things look like. Okay, the ever popular credit scores in Canada. So let me talk a little bit about this. So in Canada, we have credit scores, and what a credit score is, it basically is all of your credit products that you have, and you're generated a score based on different factors like your payment history. Do you pay things on time? Have you had items go to a collection agency? One that's become a very big issue, I'd say, over the last 10 years, because there is so much availability of credit, is what we call your percentage utilization. So if you have, 3 credit cards and they're $5,000 each, out of that 15,000, are you only using 1,000 or are you using 15,000? And if you are using the whole 15, then your percentage utilization is quite high. So these are all things that kind of impact your score. How does a low credit rating affect your life? You could have many institutions. If you want to go to Leon's, get one of those, 8-year no pay type deals or whatever the case may be, it starts to limit things. In fact, you may not even be able to get an apartment because most apartment or rental companies will run your credit to find out if it's even an option to lend to you. Are you a secure credit risk? So more specifically, things that impact your credit score. So like I said, payment history is a big one. Because the bank, if you're asking the bank for a few $100,000 for a mortgage, they want to know what your history is of repayment. Delinquencies, so have you gone 30 days, 90 days, 120 days late on your credit card? Are things into a collection agency? Have you not paid the collection agency? Balance to limit ratio. So that's, I was talking about percentage utilization. I've had clients that have had perfect payment history, and because all of their credit facilities are at the max, their credit score is very, very low. Are we your 10th stop in 2 days? So have 10 different banks or institutions or lenders pulled your credit bureau in a very short period of time? So one thing that lenders don't like is if you have several inquiries in a short period of time, because that tells them that you're credit seeking. Okay, you might be running around trying to get credit cards, and that's going to impact their credit position when they go to lend to you. Length and history of the account. So are you quite young, say 18, 19, 20, and you've only had credit for a year? Well, that might not be enough for many lenders. So how long have you had certain credit cards, mortgages, etc.? Variety of credit accounts. So, do you have just one credit card, or do you have a credit card and a loan and a line of credit? The bank actually likes when you have some different products because that shows that you can handle, for example, a car loan, which is the same payment every month, and you're making that payment. They like when you have a revolving credit line, similar to like a MasterCard, because that shows that you can work with taking money off the credit card and paying it back, taking it off and paying it back. So there's all sorts of different types of things they look at based on the different types of credit items that are on your bureau. Do you have too much? Okay, so that's become less of an issue, but it is definitely something that has loosened up a little bit. So it used to be, do you have too much credit? And the bank is worried you're going to use it all. Now they're more looking at, do you have a bunch of credit and are you managing it properly? Having said that, it is possible in some cases to have too much. One thing you may want to do, Equifax.ca, TransUnion.ca. So there are 2 credit companies in Canada. Okay, RBC uses TransUnion. A few different banks use TransUnion. Some use Equifax. They're usually pretty similar in score, but there are 2 companies out there. I would encourage you at some point to check your credit score, see where things are. You can visit their websites. If you are an RBC client, free, you can pop into your online banking and you can check your credit score for free once a month. So great advantage for being an RBC client. Pop in there, it gives you your credit score, and you'll kind of know where things sit. So, and again, I think if you have an RBC account and you're checking it through online banking, I don't necessarily think you have to check Equifax because sometimes there are things on Equifax that are not on TransUnion, but that's very, very rare. So just from a score perspective, so this is the range of credit score. So unfortunately, I could really only find an American picture with credit score on here. but our credit bureaus generally go from 300 to 900. But this picture was good enough for this presentation. So, you know, as long as you're over, if you're over 600, you're in the ballpark for a mortgage. If you can get 680 or higher, that's really the magic number. Anything below 680, and the lenders will know that maybe there was a gap somewhere, there's late payments, stuff like that. So if you can get to 680 on your credit score, that's the magic number. If you're under 600, it's very, very difficult to get what we refer to as an A lender to do any sort of mortgage with you. If you are going to be less than 20% down, which we'll talk about shortly, again, I think the magic number is 680, but if you start to trickle down to say 620, 625, you're going to start to have some issues getting credit from lenders. And again, what makes up a credit score? So, you know, payment history is the big one. So you're going to notice there that 65% of your credit score is the history plus how much you owe. Okay, so 35%, you know, length of credit, new credit, types of credit, but the big one is definitely, the big two are payment history and the amount that you owe on your credit. Okay, so how much do you need? So there's two types of mortgages that you can get. One is a conventional mortgage. So conventional means you've got at least 20% down. The bank likes that. Everybody likes that more because you have more options. You can have up to a 30-year amortization. So amortization is basically how long it's going to take you to pay back this relatively large loan. Okay, so most car loans, for example, my goodness, now we see them as high as 8 years, but you know, generally they're 5 to 8 years in that range. Well, a mortgage is a lot more money. So the bank says, okay, take a little bit longer to pay that back. So an amortization is how long we take the debt and spread out the payments. So with a conventional mortgage, if you have 20% down or more, you can actually go as long as a 30-year amortization, making it a little bit more affordable, maybe a little bit more comfortable for you as well with your payments. So conventional mortgage is very simply, say you're buying for $300,000, minus 20% is 60, you would have a mortgage for $240,000. Very, very simple. If you have less than 20% down, okay, it's still allowed. You can do 5, 10, 15% down. But what the bank says is, okay, because your down payment is a little bit less, so it's not a higher down payment, you know, your mortgage is just going to be bigger. We want you, and it's not really an option, we want you to purchase insurance at your cost to protect the bank in the event you default on the mortgage. So that is anything less than 20% down. Now, you're purchasing insurance. It's just like your regular insurance. You have to not only meet the bank standards, but you got to meet the insurance standards. Now, as an example, you probably have heard the term CMHC, Canadian Mortgage Housing Corporation. They're a crown corporation that insures mortgages for Canadians. They will issue an insurance policy based on their set of standards. So they're very, very similar to the bank, but they are a typical insurance company, you know, fit it in the box or don't ask sort of thing. So if you have less than 20% down, say you're 5%, 10%, the insurance you are purchasing, again, does not protect you, it protects the bank. Yes, it helps you get into a house because you have a lower down payment, but it ideally protects the bank in the event of default. It is not, do not confuse it with fire insurance, life insurance, nothing like that. It is completely insurance to protect the bank in the event you default, okay? There are different amounts. The insurance, it's not a separate amount that you pay. The bank, being the very nice people that we are, we take the insurance premium and we just add it to your mortgage amount. So that will also be amortized out. You can pay it separately, but in all the years I've been doing this, no one has ever paid the insurance policy separately. It is a bit of a larger amount. Like if you put 5% down as an example, the insurance premium is 4% of the mortgage amount. So that math looks like $300,000 purchase minus 5% down, which is $15,000. That's $285,000 plus 4%. So you're really kind of only putting down 1%, kind of, sort of. The higher your down payment, so 10%, the premium's a little bit less, 15%, the premium's even less than that. So more down, the better. Ideally, if you can get to 20% down, that's really where you want to be, if possible. If you got 5%, I tell everybody to get into the mortgage market. It's really important if you do have what you need to start up your mortgage. So ways to build your down payment. So, simply put, you have a savings plan. If you've got a goal in place, it could be, you might have different goals, saving for a car, saving for education. Same thing for saving for a house. Have a dedicated savings plan just for your house fund. You can use a tax-free savings account. RSPs have been in the news lately for first-time home buyers because the government just recently, and we don't quite know all the things that were released in the federal budget. We don't know how they're all going to pan out. But one thing that's pretty cut and dry is they are going to raise the amount you can withdraw from your RSP if you're a first-time home buyer. So let me just set the stage. If you have not owned a home for 5 years, okay, and that's really important to understand that. If you haven't owned a home for 5 years, you can contribute to your RSP, okay? When you contribute to your RSP, it reduces your taxable income. So if you make, $60,000 a year, for example, and technically you've got to pay taxes on $60,000 of income. But if you contribute $5,000 to your RSP, now you've only got to pay a tax on $55,000, which means the government owes you money back for the $5,000 that's not taxable because you put towards your RSP. That means you're going to get a refund. You can take that money and save it. More importantly, though, that $5,000 you put towards your RSP, you can do a withdrawal tax-free for the down payment on a new home, and you have 15 years to pay that back. So as of right now, the maximum you can withdraw from your RSP to purchase your first home is $25,000. In the most recent federal government budget, they announced that they're going to raise that to $35,000. But again, you do have to pay it back, but you have 15 years. So the whole thought here is, if you're a first-time home buyer, yes, get into your house because that makes sense for your life stage. Buy your first home with the picket fence, with your husband or wife, with your dog, with your kids, whatever, and then worry about the RSP later when you're actually, prepping for retirement. But you do have to pay back that money over the 15 years. So get into your house, that makes sense for your life stage, and then you can pay it back later. So that's where kind of the buzz is right now around the RSPs. You can also you can get a gift from a related family or friend. So if mom or dad wants to give you money for your down payment, great. If they want to give you any sort of money towards it, that is definitely allowed. There is a standard letter that RBC will give you that will indicate that you are taking the money from them. It's a gift, and they don't want the money back. So it is truly a gift. It is not a loan. It is truly a gift from family or friends. So, okay, buying your first home. So before you start your house search, and most realtors are like this now, no one will generally bring you out, or I don't want to use the word seriously. I know it says that in the presentation, but everyone kind of thinks that you're not for real. You haven't been vetted by the bank if you don't have at least a pre-approval in front of you. So a pre-approval basically says the bank, and all pre-approvals are different. Ours is a little more thorough. The pre-approval says that your credit bureau has been pulled. The lender, the bank, the mortgage person has looked at your documents, and that you can afford X number of dollars. Now, very important, a pre-approval is as good as the paper it's written on. It just says you can afford X number of dollars. It does lock a rate for you. Okay, so your rate is good for 120 days from the day we pull your credit bureau. Okay, but the pre-approval just says you can afford X number of dollars. And we're going to get a little bit more into why that's all it is a little bit later. But just remember, pre-approval just vets you. How much can you afford? Is your credit satisfactory? Does your income make sense? What does the overall picture look like for this particular client? Things we take a look at, again, your income, your net worth, how much money you have. Do you have your down payment? I've had many people come to me, they don't have the down payment yet, which is good because we can do some planning, but do you have a down payment ready to go? And of course, your credit rating, which we spoke about at the beginning. Documents can be very different. I wouldn't take this as the only documents we need. If you're self-employed, the document list changes. If you're buying an investment property, it changes. But generally speaking, your income documents and your source of your down payment is really what we're looking for, at least to start the conversation. Okay, so knowing how much you can afford. So the things that we look at when we are trying to budget for you and make sure that this is all affordable. So obviously the mortgage payment, the maintenance and condo fees. So if you're buying a house that is a condominium or has a maintenance fee attached to it, that's included in your servicing. So we got to make sure you can afford the house with that fee attached. Very, very important. Got to pay property taxes. Critical. Pay the government. You have to budget for your insurance. Okay, so home, auto, fire, etc. Utilities, gas, hydro, and water. All your different services. So phone, cable. Does anyone have a home phone anymore? I think even my mom's gotten rid of her home phone. Anyway, car payments. What are your car payments? We will take that into consideration for sure. Lease payments as well. Okay, so a lease payment is a real payment you have to pay. Loans, credit cards, debts, and of course your living expenses. So these are the things you should be taking into consideration when you decide what's affordable. For the bank's purposes, we will mainly look at your mortgage payment, your property taxes, your heat, hydro, as well as any sort of debt you have. We do build in the number you have to be at from a percentage standpoint does allow for the understanding that you have, living expenses and your cable and your cell phone and stuff like that. But these are all things the bank looks at just to figure out if you're credit worthy or not. But things that I think every first-time home buyer should have these expenses on paper or an Excel worksheet just to make sure, remember that emotional readiness we spoke about, just to make sure that you are actually emotionally ready to take on this pretty big life change. So, okay, this is where it gets interesting. So this is definitely the part of the presentation we have amended to really talk about things that have always been there, but I think based on the recent market conditions, what people are really running into. So firm approvals versus pre-approval. So we spoke about a pre-approval, okay? Again, pre-approval, we've checked your income, we've checked your credit. We know you can afford X number of dollars. Okay, so we understand that, we get it. When you actually put in an offer, okay, so once you're pre-approved, you go and you find your house. Once you put in an offer, so an offer to purchase is basically, Mr. and Mrs. Homeowner, I'd like to pay you $300,000 to purchase your house, and I want to close this transaction the end of May 30th, or whatever the case may be. That offer normally, up until a few years ago, would almost always have conditions. So yes, we'll pay you $300,000 and we'll close at the end of May, but I have 5 business days to go and make sure that my financing is acceptable. I have 5 business days to bring a home inspector through to make sure that we don't have any major safety issues in the house. I have 5 business days to confirm I can get fire insurance for the house. So normally you would put conditions in, okay? Nowadays, what we're noticing, and I wish I had a recording because I could just play the recording when people call me. You're probably hearing the term multiple offers going in on houses, houses going in up over asking, okay? When you go in firm, no conditions, you are legally agreeing to purchase that house at the agreed upon purchase price, unconditionally. You're almost giving your unconditional love to the seller, and there's not a darn thing you can do about it. Okay, so it's a tough situation because here's what happens. If you go in unconditional, and congratulations, you are now legally obligated to pay that seller $300,000, and then you come to the bank with your offer, and the bank doesn't like the property. There's a problem with the property. The property has excessive mold. The property isn't worth what it's worth, etc. You now have an issue. If you can't close your deal, you could be sued. So this is a risk right now that a lot of not only first-time home buyers, but second, third, and fourth-time home buyers are running into. The bank will do a pre-approval, good as paper it's written on. However, in order for you to be firm on your approval, the bank has to take your offer to purchase. They have to send it. I would send it to RBC, my underwriter, because an underwriter anywhere will not look at anything and give a firm approval without an accepted offer. So I will take, once the offer is accepted, firm or not, we will send it to the underwriter and they will say, yes, no, we're happy. If you're less than 20% down, I also have to send it to CMHC, because that's the insurance company. Remember, they got to approve this deal too, and then they will do their due diligence. The other thing, the third thing we have to do that we only do until we have an accepted offer is we do what we call the property valuation. So is the property worth what it's worth? Now, in an ideal world, 5 business days on financing, we send in the approval, RBC is happy, CMHC is happy, the house is worth what it's worth, we give you a firm approval and you waive your conditions. And congratulations, your house is officially yours. So that's what a firm approval is. Now everybody's checked things out. Where the issues come in is, what if we do the property valuation on your property and you have ended up paying $400,000, but the house is only worth the $300,000 that you originally thought it would be. So sorry, I have that backwards. What if the house is worth $300,000, but you have gone into multiple offers and you're paying $400,000? Okay, so this gets into my next point: value versus purchase price. If you paid $400,000 for the house and it's only worth $300,000 when the bank did that property valuation, the bank is only going to mortgage to either the purchase price or the appraised value, whichever is less. So if the house is only worth $300,000, we'll give you a mortgage based on a value of $300,000, and you would have to come up with your down payment for that amount. But then you got to come to the table with an extra $100,000 because the house isn't worth $400,000 that you're paying. So you can see where people are going firm. They're putting the deposit down, and they're kind of crossing their fingers, hoping for the best. And that's why the bank, when they do a pre-approval, warns clients, if you want to go firm, have a plan B, have a plan C, whatever the case may be, because if you go in firm and something goes sideways on financing or insurance, or you find out that, there's a huge hole in your roof, those are your risks that unfortunately a lot of people are taking right now. And it is what it is relative to the market. So to be very clear, a firm approval, and RBC is the only bank that does this. Believe me, we're the only bank that does this. Your offer is in. RBC, firm or not, RBC has approved the deal. If it needs CMHC, CMHC approves the deal, and the property valuation is acceptable to the bank. Okay. At that point, you are firm. That means you are getting your house, unless one of two things happens. If you change the property, obviously, because we had to go through that whole process again, or if you ask for more money for whatever reason. Okay, but other than that, everything is firm on RBC. And we're the only ones that do that. We don't pull another credit bureau. We don't say, oh, by the way, can I get one more pay stub? Nothing. You're firm, you're golden, you're in. Okay. So I wanted to kind of paint that picture with different examples because I think pre-approvals are great, firm approvals are much better, but the way the market is right now is very tough, and it's just kind of the way that things are going. So remember that with the value versus the purchase price. Okay, when you're talking to your real estate agent, I text a lot of real estate agents at 10 o'clock at night. You can ask my wife; that happens quite a bit. And they're kind of debating this thing with the value. We're noticing as well, because offers are going firm, and there is additional risk to the seller, we're noticing that the deposit, you got to put a deposit with your offer. It's a show of good faith. It used to be maybe $500, $1,000, $2,000. Now they're $10,000. Now they're $15,000. Now they're $20,000. I saw one in Toronto last summer that was a $50,000 deposit. Because what happens is, if you can't close your deal, something goes wrong, you went firm, and the bank has said, no, we're not going to do this financing, you lose your deposit, and you may even be sued. So again, quite a bit of risk. And that's where I think having a really good team around you helps a lot. So that's a long slide. We added that one in last minute because there was a lot of great things in there. So your home buying team, obviously, goes without saying, your RBC Mortgage Specialist. I might be biased there, but your RBC Mortgage Specialist. Your real estate professional. So if you have a realtor, great. If you don't have a real estate agent, this is where I can help you even more. I'm in the industry. I know what a great realtor looks like, ones that are going to fight for you, ones that I know will be up late texting me, trying to figure things out for you. I can refer you to an amazing real estate agent if you need. Home inspector, same thing. I've got a couple of home inspectors I work with, and I definitely have a couple of lawyers I can refer to you. So if you're starting with me, the good news is I can help you build your team so that you've got people around you that know their stuff, and they're going to go to bat for you when you need. Okay, so what we've covered today. So getting ready to buy your first home, credit scores. The other thing with credit scores too, I heard Credit Karma is very similar. I don't think it's completely accurate, but it's very, very similar. So Credit Karma could be a good spot as well. It's free, okay? Saving for a down payment. One advantage of working with RBC, I am very much a one-trick pony. I am mortgages, home financing, but I have a whole team behind me. So if you need a loan, a bank account, a savings plan, line of credit, a Visa, all the other suites of products, we offer that. I can definitely set you up, again, with someone that I know in the branch network that can definitely help you out with that. Again, bigger picture relative to building your team. Pre-approvals versus firm approval. So just remember, pre-approval, as good as the paper it's written on. Firm approval, that's after you put in the offer and we've checked everything and everybody gives you your little gold star. And then, of course, I've said this already, importance of having a team working for you. So a lot of high-level stuff. I mean, I think I could probably go through this for hours, but we wanted to just get to the really important things. So I'm going to get to questions. I can see a couple of questions coming through. I'm going to get to those in just a moment. But your next steps. So a couple of things. This is how to connect with me. Okay. That's my phone number or text. My email. Email seems to be becoming an older way of doing things. Facebook, Twitter. Twitter is definitely becoming an older way of doing things. But also too, I've got a great YouTube channel. So if you search for me on YouTube, Stephen Green Mortgage Professional, got some great information there. And I also have a great podcast called the Green Effect Podcast. It's not just about mortgages and banking. I've had everyone on there from, I had my boss on there, great interview. I've had a lawyer, I've had 2 accountants on there. I've even had a guest who was on the Canadian wheelchair sledge hockey team and the wheelchair basketball team. I've had all sorts of guests on there. So if you do listen to podcasts, take a listen. I think they're fantastic. So, but definitely take a look and give me a 5-star rating if you think the same thing. How about that? Anyway, that's how you can connect with me. So, okay, I'm going to pop into the questions here. So bear with me. Okay, and I've got two questions from Emily. So let me answer the first one. So the first question is, how often are there differences when a firm offer is presented? So I'm going to assume, oh, and then, okay, there's another question here from you related to your other questions. Let me just read that briefly. What do other banks do that is similar to firm approvals? Okay, so I'm going to try to, Emily, I'm going to try to answer this, the first part. And if I've misunderstood, I want you just to punch in another question and I can have a look at it, okay? So how often are there differences when a firm offer is presented? I'm assuming differences from, you go in firm and then a difference between, say, the value or, you know, if you're not doing an inspection, is there maybe an issue with the property or something like that? So from a value perspective, it very much depends on the market. So I would say, how often is there a difference? I probably in and around the, I'm going to say 20% mark. Now I do mortgages all over Canada. So primarily I'd say 80%, no, 90% in Ontario, but we do see differences. It happens quite a bit. I've had a couple of properties just this past spring. Well, I know we're just coming in spring, but earlier on this year, and they were, each one was like $40,000. We call it light, so 40 light. They were paying, I think, $580, and it came in at like $540. He was buying 2 properties in that case, but it's happening more. And it's a tough one to answer because I'd say if, and again, it's a tough one to answer, but I think if the appraised value or the purchase price compared to your offer price is within 5 to 10%, you're generally okay. I have no science to back that up, just experience. So if you're buying for 300, I'll give you an example I just had. Client bought, they were asking, I think, 400,000, and the final purchase price was 430. So they went 30 over asking. The good news is it went to CMHC, and actually CMHC approved it without even doing an appraisal. So based on that market, based on comparable sales, 430 was acceptable. So you sometimes have that little bit of play there, but that's not for everybody. That might not be the case for every property you purchase. So hard to put a number on it, but generally 5 to 10% you're okay. Generally, I've seen appraisals come in $2,000 light, which is more annoying than anything, but sometimes that does happen. So, and then related to your other question, what do other banks do that is similar to firm approvals? I'm assuming that you're talking about, like, instead of this RBC cool firm approval thing, often what will happen, other banks, different mortgage brokers, and I think other banks, and there are so many fantastic mortgage brokers and fantastic people who work at other banks. It's more just the different types of processes that the banks have. So as an example, at most institutions, what will happen is they will say, okay, we've seen the offer, it's approved, but, and it's usually on a separate piece of paper, there are these terms and conditions you have to meet, okay? So in those terms and conditions, there could be a full appraisal of the property, okay? So that could be one thing. You could have, we need to see one more pay stub. I know some banks 2 weeks before closing, okay, so 2 weeks before closing, they will pull one more credit bureau on you just to make sure you're still credit worthy. So you may have heard sometimes a real estate agent say, congratulations, you bought your house. Do not go and buy anything. Don't go to Leon's, don't go to the Brick, don't go buy a car, okay, until your house closes. With RBC, as long as you don't change the property or the amount, it doesn't matter. You can go buy 3 cars, doesn't matter to me. I wouldn't advise it, but you can definitely do it if you want to. That's the difference. Many other banks will do that where they'll pull kind of a last minute bureau. But having said that, there's so many great people out there that work for different banks and brokers. You know, sometimes there's things they do to make sure that you are protected. But I'm just strictly talking about process and what it all looks like. So hopefully that answered your question. And I just saw your other question saying it makes a lot of sense. Thank you, and you are absolutely welcome, Emily. So I'm glad I captured all that properly. If I didn't, you definitely know where to contact me. So. Okay, other than that, that is all I have for this evening. I hope I've captured a lot of the information that you were looking for. There is a lot of high-level stuff here. I can go in much more detail. And if you want to go into some more detail, get a plan in place. Even if you can't do it now, get prepped, get a plan, and then we can get it done as soon as we can. Reach out to me. We can make up a time to meet and take it from there. So thank you so much, everyone, for joining. And if you have any questions, you definitely know where to find me. Thank you so much, everyone. Good night.